Many a times you make a buy trade entry and immediately after buying you are expecting price to move to the upside. Then you realize that price will move to the downside and hit your stop loss, take you out, and then continue in the direction of your prediction. That is liquidity sweep. And you keep wondering, price took you out and then continue in the direction of your analysis. You feel bad, as if you were being monitored. And there are situations whereby you actually know that this zone is valid. Perhaps you are seeing it as a support zone. And upon getting a confirmation from that zone, price came into that zone, break it, and continue going deeper. That is a liquidity run. In this video, I'll be showing you exactly how you can escape being a victim of this liquidity sweep and liquidity run in a simple way, and how you can trade it like a pro. So this is a continuation of our previous video where we talked about liquidity sweep and inducement. Looking at this, you realize that this is a particular zone. So if this is your order block, this is your order block, and this is an uptrend, which means that you are having a higher low and a higher high. So you are expecting price to return into your order block so you can buy. So price return into your order block. So assuming you move to your lower time frame and the rejection on this particular candle, let's assume you move to your lower time frame and the rejection of this particular candle you are seeing here, this rejection can be a possible pin bar on a lower time frame on 15 minutes, and then you bought on that 15 minutes. You make your buy entry expecting price to move to the upside, and you now realize that after buying on that pin bar, price continue going deeper. So price came all the way down and your stop loss is below. Of course, you will say this is the structural point, so your stop loss is at this structural point here. So your stop loss is here, and this wick from this candle eventually take you out, and after taking you out, price return and continue again all the way to the upside. So this becomes your stop loss, right? This candle formation, this wick on your 15 time frame becomes your buy entry. So you bought there on a 15-minute time frame. This low here becomes your stop loss, and then suddenly price pull back to the downside with this wick. Price take you out, and after taking you out, price again pull all the way to the upside. So you keep wondering what exactly has happened. Now this is a typical liquidity sweep. Remember, at every structural point there is a liquidity sitting there. This is not a break of structure. Why is this not a break of structure? When you are considering a break of structure, you are considering the body of the candle. And look at where this body of this candle is. So if I extend the body, of this candle all the way, you realize that this body here and this are at the same level. So this body did not close below this. It is only when this body closes below this structural point that you can now call it a break of structure. So this week is a liquidity sweep. The people that bought here were taken out and price eventually returned to go in your direction. So how do you trade it? Two ways to do this. When you came into this zone, you already know that there is a liquidity formation. And because there is a liquidity formation, and you know that there is a liquidity sitting here, there is a tendency for this liquidity to be taken before price proceed to the upside. You must understand that the institution, before they will move to buy, they will begin by selling first. So when you are in a zone such as this, you need to be patient enough. Either you get a candlestick confirmation on a 1 hour time frame, or you wait on that same time frame for the manipulations to end. On your lower time frame, you should wait for a break of structure. A break of structure is very much important because a 15-minute time frame, which will have taken you out, you will need a 4-15-minute time frame to make a 1 hour time frame. So if you were to wait on a candlestick, which is this bullish candlestick pattern, you should have missed this pin bar candlestick because the pin was actually used to take away this liquidity. So again, let's look at what liquidity run. So in a liquidity run, how do we see it? For instance, in a downtrend, price is making a lower low. We're having a lower low and a lower high. So in this scenario, price is supposed to take the liquidity of the lower low in order to continue its movement to the downside. So when price approaches the structural point, which is the lower low, price will always take this liquidity of the lower low because that is the original direction of the trend. So price will always take that liquidity and price will always push lower before price will pull back again and then push much lower. So you must always take note of that. So those who trade support and resistance will now mark this zone as their support zone. So eventually, maybe on their 15-minute time frame, because of this little rejection, they will conclude that this is a buy move and then they bought, and after buying, price will eventually push lower and take them out. So please, you must take note of this and understand that anywhere there is liquidity, price is being attracted towards it. So let's look at our main chart and see how this is applicable and how we can trade it. Now on this Euro USD, you realize that this price has been in an uptrend, and of course you can see this movement and this movement. So when price move all the way down, we conclude that we had a break of structure, which is a BOS, which is now a downtrend. But however, we had this our order block that we are expecting price to come and mitigate that order block. And here we have our fair value gap that we are expecting price to come back and mitigate. So in all of this movement, we had this liquidity sitting in this zone. So if you look at this and this, anywhere you see a double top, there is always a liquidity sitting in that zone. So when you see a double top that is close to either a fair value gap or an order block, you should always know that price will always push higher to take the liquidity at that zone, because many people are seeing this double top as what? As area of support and resistance. So people believe that this is support and resistance, this is the first touch, and then this is the second touch. So they are waiting for price to retest it so they can get a candle formation and then sell to the downside. Even if price is going to sell, they will always do what? Throw a wick to take away that liquidity before they will go in the original direction. And that is why every double top you see most at times are always trapped. They are liquidity zone. So the double top must not be a perfect double top, a perfect M. Remember, we have different type of double top. This is a perfect M. There are other double top where the second leg is shorter than the first leg. This is still a double top. And there are other ones where the first leg is longer and the second leg is shorter. All of these are still double top and double bottom. So anywhere you see any of these chart pattern, it is a trap. They are all liquidity sitting above that zone, either internally in the price movement or externally outside of the price movement. So it is very much important. So what do you do? Since we know that there is a liquidity sitting here and price is always attracted to area of liquidity, we will be patient to wait for what? For this liquidity to be swept, and they will come in to make our entry. So let me show you exactly what happened now. This price is meant to do what? To sell, because we have this fair value gap that needed to be filled and we have other block up there. So because here now we now have what? A double top which has this liquidity sitting here, and price is attracted to liquidity. Price now move in that zone. So you can see that. Let me get a horizontal line and show you exactly what happened. So you can see exactly what happened here. So what happened? You see this wick was thrown above this particular structural point. So this wick, there are many people who already sold. When this price move here, there are many people who sold already. Even on this particular bullish candle that went up, you can see that bullish candle that has a rejection there. This is 4-hour time frame. So if you go to a 1-hour time frame, you will see a clear indication that you should have been in that trade. Let's move to 1 hour and let's see what happened. Okay, that is the first touch. So let's look. Beautiful. So look at this now. Pay attention carefully. So you see that in that zone we have this bearish pin bar on that 1 hour time frame. So immediately in that bearish pin bar that you are seeing here, price did what? Price throw a wick. You see that bullish push. Take away the sellers, people that sold using that bearish pin bar. Price took them out, and immediately after taking them out, price returned to the downside. And you can see that immediately after that, price begin to sell. The question now is, how do you escape this? Number one is that you must know the right place to set your stop loss. If you do your analysis if you must set your stop loss must be above that structural point. So where is your stop loss meant to be? Your stop loss is supposed to be above this order block. Your stop loss should not be attached directly to the wick of this order block. Please take note of that. That is how to avoid being a victim. If you are setting your stop loss, it must not be fixed directly to the wick of this zone, because this resistance zone is a liquidity switching here. So you shift your stop loss a little above that structural point, so that if that rejection, if at all there is any manipulation, the liquidity will be taken and you will still be in the market and price will continue to the downside. So you shift your stop loss a bit above that zone, and if it is on a lower time frame, you wait for a clear break of structure. So you can see this is exactly how you can escape this manipulation. Here again, we have an internal liquidity, and let me show you. So this is a typical liquidity run. You see this? So this price now keep moving. So here is a liquidity sitting here. So, and what happened? This is a liquidity run. So there are many people be trading this zone as a support zone, and when price came in, they saw this little rejection on that candle. They saw this little rejection on that bearish candle and were expecting price to buy, because they are treating this zone as a support zone, whereas this is a liquidity that is sitting here. So what happened? Price pushed lower, and immediately price took away this liquidity. You can see that price now move to the upside. So every area of liquidity is area of money. Look at this. This is a liquidity zone. Can you see that? And when this liquidity was taken, immediately price took away this liquidity, price went to the upside. So now, how do you trade this effectively again? Is for you to know that every valid order block will always take away liquidity. So this liquidity, this is an internal liquidity. It was taken by this liquidity round. This is a downtrend, right? Now look at this you are seeing here. These two setup you are seeing, this is a double top. There is also now another liquidity sitting here. Remember, we have a smart money cube, and there is also an imbalance in this zone. So for price to fill into this imbalance, and probably this smart money cube, this liquidity will attract this price. Price will push into this liquidity, fill this imbalance, either mitigate this smart money cube or push higher to mitigate this particular order block. And one of the characteristics of a valid order block is that it must take liquidity. So this particular order block you are seeing here has proved itself. A valid order block must, one, take liquidity, create imbalance. So we had imbalance that has been created before. These are imbalance before price now fill part of it. Secondly, this imbalance, this order block has as well taken away this liquidity sitting here, which is the liquidity run. So which means that we are continuing to sell in the direction of that price movement. And we are now having what? An internal liquidity that is sitting here. So this is a double top. And let me prove it to you that what you are seeing there is a liquidity that is sitting in that zone, and it's a double top. So let's mark this and let us trace this to a 1 hour time frame. Can you see that? This is what we are saying now. You can see that this is top number 1, this is top number 2. So what are we saying? This is a typical double top. See that wick there? So this is a liquidity that is sitting here, And here, look at, we are having an imbalance. So this is a fair value gap here. So what are we hoping to see? We are hoping to see that for price to fill in that imbalance, price will take away this double top liquidity, pull into that zone, fill that imbalance before price will now move to the downside. So this is exactly, and look at the double bottom we were showing you earlier. So you can see that. So price will always be attracted to the area of liquidity. So it will take this liquidity, come back again, take away this liquidity, and then continue to the downside. And I believe you have learned something new. Please do not forget to give this video a like, share, subscribe, turn on your notification bell so you'll be the first to get notified when we upload our next video. Thank you and see you in the subsequent video.